morning. My name is Cynthia Ruiz, and welcome to a special meeting of the Los Angeles City Employees Retirement System Board of Administration. Today is October 20, 2021, and it is 9 o'clock. Ani, please take roll.
Yes, good morning, everyone. Let the record reflect Commissioners Serrano, Vice President Son, and President Ruiz are present virtually, and we do not have a quorum. President Ruiz will preside over the board meeting. Also present virtually is General Manager Neil Guglielmo and Legal Counselor Miguel Bahamon.
Thank you so much for that. Welcome to our very first ever Emerging Manager Symposium. Today is a special meeting not to handle department business, but to serve as an educational opportunity to inform our emerging managers how to do business with us. We are committed to providing opportunities for everyone, and we are committed to diversity. LACERS is a multi-billion-dollar public pension plan that administers retirement benefits to over 40,000 civilian employees. LACERS has a long history of working with emerging managers and understands the challenges faced when building relationships with prospective institutional investors like LACERS. We also understand the difficulty of networking virtually like we've all had to do over the last year and a half. As a part of our relationship building process, LACER seeks to identify the best qualified managers in the industry and build a bridge between your firm, our staff, and our consultants. At this time, I'd like to take the opportunity to thank Commissioner Nilsa Serrano, who has been on the LACERS board for the last 8 years. She has been the driving force behind our Emerging Manager program. I also want to give a special shout out to our entire investment team that has worked so hard to put this symposium together. But I really want to take this opportunity to thank you. Today is about you. So thank you so much for showing up today and spending time with us this morning. Now, I'm the first one to admit that doing business with the city of Los Angeles is not always easy. And if you're responding to any of our requests for proposals, RFPs, it could be a lot of paperwork. But we're here to help you, guide you, and help you navigate this process. So let's get started. First up is Rod June, our CIO, our Chief Investment Officer, who will be discussing the state of the LACERS Emerging Manager Program. Take it away, Rod.
Thank you, President Ruiz. Before we begin, let's take a look at an abbreviated symposium agenda so we can see how the day will unfold this morning. Today's program is divided into 2 distinct segments. First, the public markets program, and second, the private markets program, and is expected to end at 11 a.m. The full Emerging Manager Symposium agenda can be found at lacers.org on the rotating message board. During the symposium, you may have questions for staff and the consultants. Please use the Zoom Q&A button to ask questions during the course of the symposium, and staff and consultant will do their best to address them. If we aren't able to answer your question today, we will make the questions available on the LACERS website in several days. Please note that the Zoom raise hand function will not be operative for questions, so please use the Q&A function. Finally, please register your firm on LACERS RFI notification service on LACERS website to let us know you attended and to get future notifications of future EM events and any RFPs and RFIs. Okay, let's get started. I am pleased to provide the 2021 State of LACERS Emerging Manager Program. To better understand where we are today and where we hope to be, we need to go back nearly 20 years ago when LACERS first carved a path and built an internal culture to increase our exposure to emerging managers, or as we know you by EMs. It was then that several $100 million were earmarked for small and emerging investment managers, starting around 2003 and lasting through 2010. At that point, the EM program paused for a couple of years so that the board and staff could reflect on our results and then refresh the program with a new EM policy. In 2012, the new LACERS EM program only placed 60 million with a handful of managers. It was a slow start, but important nonetheless, that led to steady increases in the number of EMs on our roster in the following 7 years, as depicted in this bar chart. Fast forward, LACERS has made significant headway year over year, where we count 29 EMs on the roster through October of 2021. LACERS has also increased the dollar exposure, as depicted in this bar chart diagram from 2013 to 2020. Since the restart of the program in 2012, LACERS has invested and committed over $900 million to EMs. In 2020 alone, we invested and committed $250 million in capital to 4 public and private market EMs. That's a 300% increase over the amount committed in 2013. For 2021, LACERS has already committed or plans to commit over 80 million to emerging manager private equity funds and seeks proposals from EMs in other ongoing searches. Let's take a look at EM exposure on a percentage of dollar basis, as depicted in this bar chart. Looking at the next slide, you can get a sense of the same exposure, but broken down by broad asset class level in this slide. While asset class exposure levels reflect an upward trend, by policy, LACERS expects to place no less than 10% of its capital with qualified EMs. The charts we have reviewed reflect progress, but this is not good enough. We believe that placing capital with EMs is a key factor in helping LACERS meet its performance objectives. We want to build portfolios consisting of the most qualified managers in the industry, and that includes EMs. We need to work more strategically, smarter, and work harder. Our EM outreach in 2020 was robust. Staff attended 11 conferences and events and took 74 meetings with EMs. Staff and our 3 consultants continue to collaborate to meet new EMs coming to market, but we also want to strengthen our relationship with those whom we have already met. Thus, I am mobilizing my entire professional staff to get out there to meet you, and I am encouraging our investment consultants to cast a wider net to capture more EMs as part of our search and selection process. LACERS pays over $1 billion in retirement and health benefits each year to its retirees and beneficiaries. We need the best investment managers on our team to help us deliver on these promises. We want your firm to compete to be a member of our team. I look forward to working with you in the future. Now, I am going to turn the symposium over to my investment staff and consultants, starting with Brian Fujita, who will explain our emerging manager program from A to Z. Brian, take it from here.
Thank you very much, Rod, and good day to all of you. I'm Brian Fujita, Chief Operating Officer and the head of the public markets team at LACERS. I'd like to start off by saying that my team and I are very honored to be hosting you today at LACERS' very first Emerging Manager Symposium. And over the next half hour, we'll be providing you with a comprehensive overview of LACERS' emerging manager policy as it pertains to the public markets and the process by which LACERS hires public markets investment managers. Since one of the primary goals of today is for you to get to know us, I'd like to begin by introducing the 4 other key professionals on the public markets team, starting with Barbara Sandoval, who is responsible for the domestic equities and public real assets asset class. Barbara is also the coordinator of today's wonderful event today. So if you get a chance to meet her, please thank her for putting on this excellent, spectacular event. Next up, we have Ellen Chen, who is responsible for the non-US equities asset class, as well as LACER's ESG program. Jeremiah Paras, who's responsible for core fixed income and the credit opportunities asset class. And last, but certainly not least, James Wang, who's responsible for total fund risk management. Collectively, our team manages about 18.6 billion of public markets assets invested across 31 strategies and 24 investment managers. If you're seeking to do business with LACERS on the public market side, we are the professionals that you will want to build relationships with. We are also joined today by Carolyn Smith at NEPC, who serves as LACERS General Fund Consultant. Carolyn and her team assist LACERS with total fund asset allocation, public market asset class structuring, and public markets investment manager searches, among many other important activities. You'll hear more from Carolyn later on today in the program. We'll be providing you with a substantial amount of information today in a very short period of time. So I want to highlight 3 points about LACERS policies and practices to help you navigate through this maze of information. And the first point starts off with the emerging manager policy criteria. Now, Barbara will be discussing this criteria in detail, but wanted to highlight that qualifying as an emerging manager pursuant to the LACERS policy is primarily assets under management based. Diversity criteria such as race, gender, sexual orientation, etc., are not considerations in LACERS policy due to procurement laws and California Proposition 209, which prohibits the use of such factors in contracting decisions. That being said, LACERS is very much focused on improving our outreach to diverse firms that can produce long-term risk-adjusted returns for the LACERS portfolio. In fact, the symposium is our latest outreach effort to meet emerging managers who may also be diverse managers. The second point that I wanted to make is how the LACERS emerging manager policy integrates with LACERS investment manager searches. As Jeremiah and James will discuss shortly, LACERS investment manager searches are conducted according to a very well-defined process established by the manager search and selection policy. In order to meet the policy goal of allocating no less than 10% of public markets assets to emerging managers, the LACERS emerging investment manager policy seeks to relax some of the minimum qualifications to participate in LACERS searches to allow emerging managers to compete on equal footing with more established firms. Again, Barbara will discuss the criteria of this policy in further detail. However, it's very important to note that while some minimum qualifications to participate in a search are relaxed for emerging managers, both emerging and established managers are evaluated against the same performance hurdles as LACERS is, first and foremost, looking for managers that can add value to the portfolio. The final point that I wanted to make, and this is probably the most valuable tip for you today, as it pertains to public market searches, is how LACERS conduct searches for new investment managers and how you can stay informed of opportunities offered by LACERS. So in order to hire new public investment managers, LACERS conducts open competitive bidding processes via requests for proposals. All firms that meet the minimum qualifications of the RFPs are welcome to apply. And what this means for you is that we don't rely on consultant focus lists to identify our managers. Any firm that's qualified to participate in a search based on the minimum qualifications of an RFP are welcome to apply. So these RFPs can be easily missed if you aren't tuned into LACERS because they're only open for a very short period of time, generally about 2 months from the date of issuance. While we do our best to conduct outreach to notify emerging managers of current RFPs, it's always a challenge for us to reach all of you. So therefore, I wanted to inform you of ways that you can stay up to date with LACERS to ensure that no opportunities pass you by. First, you can review our board meeting agendas and minutes posted on the LACERS website. Secondly, you can search for articles on LACERS and advertisements published by LACERS in trade publications such as Pension and Investments and Emerging Manager Monthly. And probably most importantly is just to reach out to us and maintain a relationship with us so you can always know what's going on. Finally, I wanted to reiterate Rod's comment earlier about registering for the LACERS RFP RFI notification system on the website. As a registrant, you'll be automatically notified via email of any investment RFPs issued by LACERS. I hope you find this information useful as you seek to compete for future investment opportunities offered by LACERS. At the end of today's symposium, we'll be providing you with contact information if you desire to schedule the meeting with the public markets team. We look forward to meeting you, or if we already know you, we look forward to catching up with you. I'll now turn the spotlight to Ellen Chen, who will provide an overview of LACERS ESG program.
Thank you, Brian. I'm Ellen Chen, Investment Officer 1 for the Public Markets team. I focus specifically on the non-US equity portfolio, and I also serve as LACERS ESG Risk Officer for the entire portfolio. ESG, for those who don't know what it stands for Environmental, Social, and Governance. LACERS has long recognized the importance of addressing ESG risk in order to protect and enhance investment returns of the portfolio. Since the mid-1980s, LACERS has adopted several policies to address ESG risk. These include our geopolitical risk policy, our proxy voting policy, and of course, our emerging investment manager policy. LACERS reaffirmed the importance of ESG when we became a PRI signatory in September 2019. PRI stands for Principles for Responsible Investment, and this is a signatory membership organization of investors who are committed to incorporating ESG factors into their investment decision. LACERS is currently working on a responsible investment policy, which will encompass our entire investment portfolio. ESG risk factors may be applied to asset classes differently in materiality or magnitude, depending on the asset and the feasibility of implementation. However, LACERS priority remains our fiduciary duty to LACERS beneficiaries, who are retired Los Angeles City employees. At this time, I'd like to turn it back over to Barbara Sandoval to provide more details about our emerging investment manager policy.
Excuse me about that. Thank you, Ellen. Got my mic going now. I'm Barbara Sandoval. I'm covering the emerging manager criteria for public markets. This would include such strategies as U.S. public equities, non-U.S. public equities, core fixed income, and several strategies within the credit opportunities and real assets. LACERS emerging manager policy describes the following 6 criteria for emerging managers. Firm assets under management. The firm will have no more than $2 billion in total firm assets under management at the time of hire. Strategy assets under management. The firm must have a minimum of 50 million assets under management in the strategy being considered. Formation date. The firm, if formed as a result of an organizational spin-out of at least a majority of key investment team's senior level professionals, must have been in existence for a minimum of 6 months based on the entity's legal formation documents. Otherwise, the firm must have been in existence for a minimum of 1 year based on the entity's legal formation documents. Track record. The portfolio manager must have a minimum of 5 years of verifiable experience managing the strategy being considered. The experience must include a GIPS compliant performance track history attributable to the portfolio manager for the most recent 36-month period of the 5-year verifiable experience requirement. Firm ownership. No person or entity other than the principals and or the employees of the firm shall own more than 49% interest of the firm. And 6, maximum LACERS allocation. At the time of hire, funding in the investment strategy shall not exceed 20% of the total strategy assets under management at the time of actual funding. Now, all these criteria are part of our emerging manager policy, and the policy is also available for viewing on our LACERS website. Following the symposium, we will also provide a recap of these slides, so you'll be able to access this information at your leisure. At this time, I would like to turn it over to my fellow investment officers, Jeremiah Paras and James Wang.
Thank you, Barbara. Good day, everyone. My name is Jeremiah Paras, and together with my fellow investment officer, James Wang, we shall describe how the manager's search and selection policy provides a comprehensive framework for the search and selection process for public market strategies. The first section of the policy, roles and responsibilities, specifically defines the responsibilities and processes for the LACERS board, staff, and the general fund consultant. The highlights of the board's responsibilities include the authorization of a search, the review and adoption of minimum qualifications or MQs for search respondents, review of semi-finalist candidates, interview of finalist candidates, and the selection and hiring of investment managers. Key roles of the staff include recommendation of search mandates, the actual implementation of the search process, development of a written set of MQs, due diligence on the semi-finalist firms, and a recommendation of finalist firms for the board to interview. Lastly, the general fund consultant's responsibilities are largely hand in hand with those of the staff, from developing the search recommendation to coming up with additional MQs. Key roles specific to the consultant include screening the qualified respondents and recommending semi-finalists based upon a set evaluation criteria. These roles and responsibilities of the board, staff, and the consultant are described in further detail within the policy. The next section of the manager search and selection policy lines out the actual sequential search and selection process in extensive steps. The slide shown here captures this process. In brief, a manager search begins with staff and consultant recommending a mandate for board approval. The board authorizes the search along with additional MQs which may have been tailored for the specific search. The consultant applies these MQs to determine the qualified respondents among the proposals submitted. A set evaluation criteria is applied to arrive at a list of semi-finalist candidates. Following board review of this candidate evaluation, staff conducts due diligence on the semi-finalists. Based upon the findings of the due diligence, staff then develops a list of finalist candidates who are then interviewed by the board, which then authorizes the selection of investment managers based on the finalists' interview and staff recommendation. As mentioned, LACERS public markets manager searches are conducted through a request for proposal or RFP. LACERS invites all qualified firms to participate in its manager searches. We are aware that an RFP submission could be a huge undertaking, especially for firms less familiar with the process. Aside from the questionnaire and required attachments, all proposers must review and complete certain city required and compliance forms. So to this end, we have developed a city required and compliance forms tutorial, which aims to provide additional clarity and instructions for reviewing and completing the said forms based on frequently asked questions. This document is made available and is part of the documents released alongside the announcement of a manager search. At this point, I'd like to turn you over now to James Wang, who shall continue on with some information on the evaluation criteria and the minimum qualifications for searches.
Thank you, Jeremiah, and good morning, everyone. I'm James Wang, and I will cover the search evaluation criteria and the qualifications. So for the evaluation criteria for active strategies, active public strategies, 70% of the score will come from the qualitative assessment, 20% will come from the quantitative assessment, while the remaining 10% will come from the evaluation of fees. The 70% qualitative assessment is further broken down into 30% for assessment on the organization and people, 40% for the investment process, and 30% to risk management. Now, we also have a different set of evaluation criteria for passive strategies. For passive strategies, 50% of the score is attributed to the expected fees. 40% comes from tracking error, and the remaining 10% comes from the qualitative assessment, which is split 50-50 between product, assets under management, and the assessment of the firm's organization. Now on to the minimum qualifications. For active strategies, the minimum qualifications include that the firm is a registered investment advisor under the Investment Advisors Act of 1940 or possesses a bank exception. The firm must have a proven and verifiable track record which conforms to GIPS of at least 5 years as of the most recent quarter end. And at least 60% of the rolling 4-quarter information ratio must be positive versus the mandate appropriate benchmark gross of fees for the last 5 years. And the strategy AUM must be sufficient size that LACERS expected mandate size will not comprise more than 25% of the proposed product assets. For passive strategies, the minimum qualifications also include that the firm is a registered investment advisor under the Investment Advisors Act of 1940 or possesses a bank exemption. And the firm must have a proven, verifiable track record that conforms to GIPS of at least 5 years as of the most recent quarter end, and that the strategy AUM must be of sufficient size that LACERS expected mandate would not comprise more than 50% of the proposed product assets. And so for each search, the expected minimum number of emerging managers are identified in the beginning of the search. And as RFP participants respond, the summary of emerging manager candidates are further reported to the board. And with that, I'd like to take it back to Barbara. Thank you.
Thank you, James. At this time, we'd like to hear from Carolyn Smith with NEPC.
Good morning, everyone. My name is Carolyn Smith, and I'm with NEPC. And if you'll turn to page 1 of my slide deck, I'll just give you maybe the next page there. I'll just give you a quick update for those of you who are not familiar with NEPC. We are the board's generalist consultant, and we're a large independent firm. We work with about 400 different clients, including 70 public fund clients. Most of our manager research is conducted by a dedicated research team that is primarily located in Boston, but people like myself, generalists, also get involved in the research process. So if you turn to the next slide, I want to just spend a minute talking about how we engage with the emerging manager community. There are several ways that one can get in touch with us. You can, if you meet the description that I've included here on this slide of diverse owned or diverse led firms, we have an annual equitable manager participation workshop where we invite managers into our firm and have them meet with our research team and understand our research process, similar to what we're doing today. We also have a web here we're showing that you can send your information directly into diverse managers at nepc.com. That goes straight to a committee where we will look at your information and give you some feedback within 3 months of submitting that data. And then another way that we also want managers to engage with us is really to keep your data up to date through eVestment Alliance. We definitely use that universe for performance and other statistics that we are looking at for portfolios. But there are a number of ways that an emerging firm can get through to our clients. So first and foremost, our traditional way where we have a standard due diligence process where we are maintaining focused placement lists. That's one way to get through to our clients. Another way, we have a couple of different ways. If you have a very niche product that perhaps isn't applicable for the vast majority of our clients, we have a discovery platform process where we will evaluate firms and niche products that may be appropriate for some of our clients. And then finally, our newest program is called the Explorer program, and that is our commitment to the emerging manager community to evaluate products and get them rated so that they can be included in searches for clients. We also have a turnkey solution for some clients that want to hire fund of funds programs. And so we have a process where we vet those programs for clients. And then finally, another way to get through it is client-directed searches, similar to what LACERS conducts. So if you turn to the next page, I know that James and Jeremiah went through the process and the criteria, et cetera. But before an RFP is issued, emerging managers are welcome to contact our research team. They're welcome to contact the consulting team to LACERS, or they're welcome to submit data through the diverse managers at nepc.com. Once an RFP is issued, the LACERS consulting team really kind of stops communicating with the emerging manager community for that particular search. And we really focus in on the evaluation of the proposals that have been submitted. And so what we do initially, we go through and make sure that every proposal meets those minimum requirements as previously described. And then if they do, we then will read through every proposal and score them, and then assist the client, the staff, as well as the board members with making a decision. So finally, on the last slide here, I just wanted to introduce the team members that do work on the LACERS account. We're listed there. You can contact any one of us. If you don't know anyone in our research team, we can get you introduced to the appropriate research person. Our telephone number is listed on the right-hand side of this page, and it will reach anyone in our organization. So that's the one way to get in touch with us. And if you don't know folks in our research team, I just encourage you to come through the consulting team, because we can get you connected with the right and appropriate person. Thanks.
At this time, we'll turn it over to Brian Fujita to start the Q&A session regarding public market.
Good day to all of you again. So if you have a question, please type it into the Q&A box, and I'd be happy to address those questions. There was one question earlier about where on the LACERS website is the RFP, RFI notification system located, and we've provided a link within the Q&A box. So refer to that. You can click directly on that link and be at the RFP notification system. So as we wait for questions to come in, I'll answer a question that we received in advance. And the firm asked, how do you make sure that you're backing underrepresented female managers? So if you recall earlier from my presentation that because of procurement laws, we can't consider diversity criteria in our hiring practices. So we can't directly control the demographics of the firms that we contract with. What we can control, though, is the outreach that we conduct to these firms to make sure that our candidate pool, when we conduct searches, is as broad as possible. And I mentioned that this is one of the formats that we're using in order to conduct that outreach. If you review LACER's Emerging Investment Manager policy in detail, you'll notice there's a section at the end that discusses the use of what we're calling an organization diversity survey. And that's one tool that we'll be using to be able to determine how we can conduct better outreach to diverse firms. And I won't discuss that in detail, but you can review that on your own time. Okay, there's a question about the 70% breakdown of the qualitative assessment. So James, could you go back and provide how we break out the 70% scoring criteria for RFPs and searches?
Yes. So for the 70% of the qualitative assessment, so 30% of the 70% will be an assessment of the organization and people. 40% of the 70% will be on the investment process. And the last 30% of that 70% will be risk management. Hope that answers it.
Okay, thank you, James. There's another question. Please elaborate on the required 5-year track record. Will you permit linking together a carve-out performance from a prior firm along with a GIPS compliant performance at a current firm? I'll take a shot at answering that question. And the short answer is, if you are an emerging manager firm, pursuant to LACER's policy, then yes, we will allow you to link those records together. We realize that the 5-year GIPS compliance is generally a hurdle for newer firms. So what we've done with our policy is to be more accommodative to newer firms and allow a relaxation of that GIPS compliant record. So the answer to that question would be yes. Another question we received is, are your AUM requirements adjusted or relaxed for strategies that tend to represent a very small percentage of average plan AUM? For example, small cap value. I'm not sure that I'm clear about this question. Our AUM requirements for the emerging manager policy are based on total firm AUM. And as Barbara had mentioned, that's 2 billion or less. In particular, manager searches. James, can you please review the criteria?
So for the specific searches for active strategies, the strategy AUM must be of sufficient size that LACER's expected mandate size will not comprise more than 25% of the proposed product assets at the asset level of the strategy.
Thank you, James. And if you need further clarification on that answer, we'd be happy to discuss that one-on-one with you. Okay, the next question is there an outline process on how to engage and who we can engage with? So I had mentioned earlier that we'll be providing some contact information at the end of the symposium. That's our general lacers.invest email inbox. And your request will be directed to the appropriate investment officer upon receipt of your email. Okay, the next question is, when you mention the requirement of $50 million in AUM within the strategy, can you please provide examples? So the simple example is that we require strategies that have at least $50 million in composite AUM. So if you're running, say, a small cap equity strategy, that strategy has to have at least $50 million in AUM generally in order to participate in a search. Okay, another question is, what are some of the criteria you focus on for risk management assessment? And again, I'm going to refer this question to James. And James, you can discuss this in further detail.
So I had an issue for a second there.
So generally speaking, when we're conducting a risk assessment of a firm during the due diligence phase, what we're really looking at is the strength of your organization, the strength of your internal controls, your compliance practices, and other factors that might present a risk to the management of the strategy. And I'll let James detail that a little further.
Mm-hmm.
James?
Sorry about that. So as we usually look, we will we will be looking into the factors.
Okay, I'm going to move on to the next question. We'll address that in the written Q&A at the end of the symposium.
Brian, this will be the last question.
Okay, thank you, Barbara. So this last question is a good question. It says, with the restriction to not exceed 25% of a firm's AUM, can you share the minimum investment you would consider for an emerging manager firm? Again, that's really dependent upon how much AUM is within a particular strategy. But generally speaking, in previous searches, we've committed as low as $30 million to an emerging firm on the public market side. But it's really dependent upon the circumstances of that search and what we're looking for in terms of the portfolio fit and the number of managers that possibly competing in that search.
Thank you, Brian. Again, with the Q&A, if we're not able to get to your question today, we will be posting on our website in the next few days or so, the questions with some responses. At this time, I'd like to turn it over to Commissioner Serrano, Nilsa Serrano.
Thank you. Good morning, everyone. My name is Nilsa Serrano, and it is my pleasure to be in part of and welcome you to the first ever LACERS Emerging Manager Symposium. This effort is a clear demonstration of how committed staff, consultants, and trustees are to expanding our Emerging Manager program. Studies clearly demonstrate that emerging managers provide access to strategies that are often missed and earnings that are left on the table. Our goal at LACERS is to review, evaluate every opportunity presented to staff and our consultants, and find the right partner that can enhance our portfolio. We owe that to our retirees and their portfolio. With that in mind, I would like to encourage all EMs to register on our RFP and contracting opportunities notifications on LACERS websites under the investment tab. I would also encourage you to click every box, even if the RFP does not apply to your asset class. You may know an emerging manager that fits that profile. This is a simple step on how you can help us develop a large network of emerging managers. Also, please let your EM colleagues know that LACERS is open for business. In closing, I want to thank you on behalf of the staff, consultants, Board of Trustees for your willingness to be here today and to one day manage assets on our behalf. As always, LACERS staff, consultants are always available to answer your questions on our Emerging Manager program. I look forward to seeing more emerging managers brought to our investment committee. Thank you and good luck.
Thank you, Commissioner Serrano. At this time, we'll switch over to our public markets team. And I'd like to turn it over to Wilkin Lee.
Great, thanks very much, Barbara, and good morning, everyone. Nice to meet you all virtually. I'm Wilkin Lee and the Director of Private Market Assets here at LACERS. So before I start, I want to thank Commissioner Serrano for all of her hard work and advocating on behalf of the emerging manager community. So what I intend to do next is to go over the structure of the private markets team and talk about how emerging managers fits into our overall portfolio. In my team, I have 3 other highly qualified investment officers who cover the private market asset classes. You'll have a chance to hear from them shortly, but they are Eduardo Park, Robert King, and Clark Hoover. Within each of the private market asset classes, we handle our commitments slightly differently. We have it structured from a governance perspective where we can quickly commit to funds where there are short fuses, and in cases we have the luxury of more time, we have the investment committee and board involved in the decision-making process. For private equity, we have a streamlined selection process that allows staff and consultants to prove commitments within policy guidelines. LACERS is able to commit to funds without board approval if there's concurrence from our consultant and staff up to $50 million for a first-time fund and $100 million for a re-up. In terms of background on our private equity portfolio, we have been investing in this asset class since 1995. Right now, we have a very seasoned portfolio that has a market value over $3 billion. This consists of 300 partnerships with 140 general partners that are well diversified geographically and by strategy. We recently increased our weighting to private equity by 2 percentage points and have a target percentage of 16% for this asset class. For private real estate, we go through a closed session process with our investment committee and board, where they have the chance to interview our prospective GPs and determine the overall fit. In our real estate portfolio, we have 42 commingled funds that are broken out by core, value add, and opportunistic strategies. And then we've been investing in real estate since 1989. Similar to private equity, we increased our allocation by 2 percentage points to a 7% target. Our real estate value is around $800 million, and our commitment sizes are typically range between $30 and $50 million. For private credit, we have 3 fund of ones that were selected through a RFP process. Our target asset class also went up by 2% to 5.75% recently. Our intention is to initially commit $100 million to each of these managers and to increase the commitments by $125 million each for the next 3 years. So the question I'm sure you're all wondering about is how much we typically commit to emerging managers. And the answer to that is typically around 10 to 20 million per fund. By policy, LACERS expects to place no less than 10% of its capital with qualified emerging managers, and that is something we constantly strive for in working with our consultants and while speaking with prospective investment managers. Irrespective of the asset class, we always make sure that we conduct thorough due diligence in all the funds we commit to. Our goal is to build long-term relationships with our investment managers, particularly on the private market side, as we realize that investments can last 10 to 15 years. Given our complex portfolio, we work very closely with our consultants in making sure that we monitor our existing investments and bring on new investments that are additive to our portfolio in terms of performance. Later on during this presentation, you have the opportunity to ask questions to Axia and Townsend and find out how they are working with us in committing to emerging managers. The important thing to do is to get your foot in the door and establish a relationship with staff and our various consultants. Given that we get numerous requested data to take meetings, it's helpful to develop a rapport with us. That way we know who you are and what strategies your firm specializes in. We're all active in the usual conferences, so don't be afraid to say hi to us or drop us a line. I know it's a bit more challenging now since we're all working from home, but we're still taking introductory meetings virtually and can follow up later once we have more time. So we'd like to establish a first step in getting to know you. As you can imagine, we're probably going to get a lot of inbound inquiries after the symposium. To the extent there's a mutual fit, we will make it a priority to get to know your firm. This inaugural Emerging Manager Symposium is a great opportunity for us to reach out to you all and also for you to understand what LACERS is all about. So with that, I want to thank you all for listening, and I will pass it over to Clark Hoover, and he will go over the Emerging Manager Policy.
Thank you, Wilkin. My name is Clark Hoover, and I'm an investment officer on the private markets team. I want to say thanks to everyone in attendance. For those of you private markets managers whom we have already met, we look forward to continuing our conversations with you. And for those of you that we have not met, we look forward to starting a conversation with you in the weeks to come. So I'm going to review the criteria to qualify for the LACERS Emerging Manager Program for private markets. Now, you'll notice some similarities to some of the criteria to the public markets mandates that were already discussed. But there's also some differences that are there to account for the characteristics of private markets that are different from public markets. Now, these criteria can be found in our investment policy. It's posted on the LACERS website, and we periodically update it. So you may want to just keep, make sure you're using the most current version in case you need any tweaks or changes. Now, to be clear, meeting the criteria does not mean that we're going to necessarily or for sure make an investment. What it does mean is that you qualify to be considered as an emerging manager, and that will be taken into account as we move forward, and then you'd be evaluated through the due diligence process, and we move forward from there. So with that, let's begin by reviewing the private markets criteria. If we could put up the slide, please. Terrific. So as you can see, there's some similarities here. So institutional funds, it's first, second, or third time institutional fund. Maximum fund size, these are going to be different than what you saw before. First time fund, $750 million, second time, $1 billion, and third time fund, $1.25 billion. Formation date, I think similar to what we saw in the public markets, 6 months if it's a spin out of a majority of key folks from an existing firm. Otherwise, 1 year. Track record, again, 5-year verifiable track record of key individuals, and attribution from prior funds is allowed. And as Brian said earlier, we can work with you because we know that sometimes not all firms necessarily give you attribution, so we can help walk you through a process to make sure we can try to address those track record questions. Firm ownership, majority owned by principals and or employees. LP concentration, no LP can represent more than 30% of the total fund's committed capital, and this excludes co-investments and sidecars. Minimum fund size, $100 million, and that's a lower amount, $75 million for venture capital because VC funds tend to be a bit smaller. And again, this excludes co-investments and sidecars. And as far as the maximum LACERS commitment, 10% of projected fund size or $30 million, whichever is lower. So, and I just want to mention also, this is private equity, real assets, and credit opportunities. So the next slide, we're going to talk about private real estate, which has slightly different criteria. Now, much of this is going to be the same. You'll see institutional funds, again, first, second, third, but here's a difference. Maximum fund size, $2 billion. Formation date, again, the same, 6 months, 1 year. Track record, the same, again, 5 years, 5 years of verifiable track record. Firm ownership, again, the same, majority owned by principals and or employees. Limited partner concentration, again, 30% is the limit, excluding co-investments and sidecars. Minimum fund size, this is a different number here for real estate, $150 million. And similarly to the other private markets policy, it excludes co-investments and sidecars. And maximum LACERS commitment, again, this is slightly different. The lower of 10% of projected fund size or $30 million, but for second or third time funds, it's the lower of 20% or $40 million. So that covers our policy for qualification of private markets. I'm sure there'll be questions, so we'll get to them, but with that, I'd like to pass it over to my colleague, Robert King.
Thank you, Clark. Good morning, I'm Robert King, and I'm going to briefly cover our private equity policy, which can be found online in our board governance manual on pages 180 through 185. I'm going to highlight a few important points from the policy, but I'm going to spend most of the time on section F on the roles and responsibilities of the board, staff, and private equity consultant for investment selection. So could you please put up the slide? Thank you. So this slide provides a high-level overview of our manager selection process, and I'll provide a few additional details during this presentation. So as mentioned by Wilkin, LACERS can invest up to $50 million with new relationships and up to $100 million with existing relationships on the recommendation of our consultant and concurrence by staff. So we'll get to how that process works momentarily. The policy also allows us to commit up to $50 million in direct co-investments and also to buy or sell positions on the secondary market. Up to 25% of our fund's total exposure by fair market value plus unfunded commitments may consist of these opportunities. Moving to roles and responsibilities, I'm going to focus on investment selection. So the board's role in selection is to approve new partnerships that exceed $50 million for a new relationship or $100 million for existing relationship, or $50 million for co-investment or secondary sales. So in practice, most of our commitments are usually below these thresholds, and we do not bring items for approval to the board, but the option is there. Moving to staff, the first part of our job is to conduct meetings with prospective general partners and refer these investments to our private equity consultants. While Axia does most of the heavy lifting for due diligence, staff also frequently do some of our own work and get comfortable with a potential investment. So we do reference calls, additional meetings with the manager, we may review information in the data room, et cetera. We hold regular discussions on our upcoming pipeline with Axia, where we may ask further questions or we may request that they seek more information on a particular topic. So when Axia has completed their formal due diligence process, which includes investment due diligence, operational due diligence, ESG work, they present a formal recommendation to LACERS staff on the potential investment. LACERS staff will then hold an internal discussion and the CIO will determine whether the staff concurs with the recommendation. I would note that occasionally we will seek some additional information at this point before moving forward, particularly if there's something that we need clarification on. So once Axia has made the formal recommendation and it's been approved by the CIO, staff then coordinate with the city attorney and external counsel to complete the subscription documents and side letter. We also gather any additional documents that are required, such as the third-party marketer form, et cetera. When the legal process is complete, staff are then responsible for walking the documents through a detailed execution process that includes multiple layers of final review. We also complete various administrative tasks, such as setting up new accounts with our custodian bank. Once the investment is complete and our investment in the fund has closed, staff then work on notification memos to the board, providing an overview of the investment. Moving to our private equity consultant, by policy, they are responsible for conducting appropriate analysis and due diligence on investments, preparing reports, and for approving recommendations with staff concurrence. So momentarily, David Fan will be going into that process and how that works for Axia. So the important point here is that both Axia and staff need to approve a new investment. We work with our consultant on a regular basis. We discuss the pipeline on an ongoing basis. So it's pretty rare that we get to the point of recommendation without both being on the same page. But it's important to know that these two processes are independent and that neither Axia nor staff will approve an investment that we are not comfortable with. So with that, I'd like to hand it over to Eduardo Park, Investment Officer 2, to discuss our private real estate policy.
Hey, Robert and Eduardo, before I jump in, I just wanted to introduce our Vice President of our Board of Trustees, Commissioner Sun Won Sung. He would like to say a few words as well to the group.
Well, thank you. I don't have a polished speech like Commissioner Serrano had. That was an excellent speech, but let me just make a few comments. I'm a businessman and educator, professor. When I see my graduates, they graduate, they thrive, that gives me a great deal of satisfaction. As a matter of fact, in my job, that is the best compensation. When I see the Emerging Manager Program, I've said, I'm excited, and this is the right thing to do for LACERS and then hopefully for many other funds as well. You are professionals. I'd like to see you get bigger, better, and become more important. And that would be good for you and then good for us. It's a win-win situation. We are told that emerging manager program is good for us in many aspects, but also in terms of our performance. And that's one of the things that we are counting on. I've said many times that we want to do emerging managers program like we are doing today, but we are not willing to sacrifice yields. We want to achieve that 10% goal, but not come hell or high water. You've got to perform. So I hope we make this very clear. We're excited, the right thing to do. We want to support you, but it has to be a win-win situation. So I'm looking forward to a great partnership between LACERS and then you, the emerging managers. Let's have a win-win situation. Thank you.
Thank you, Commissioner Serrano. Excuse me, Commissioner Son.
Son.
Thank you, Commissioner Son. At this time, we'd like to turn it back to Eduardo Park, Investment Officer on the real estate asset class.
Hello, hopefully everyone can hear me, and welcome. My name is Eduardo Park, and I am one of the investment officers working on the private markets team. I mainly focus on the private real estate portfolio, but help out on private equity side as needed. I'm here to quickly summarize the investment policy for the private real estate. This can be found on page 186 to 197 in the LACERS Investment Policy Manual. If you don't already know, the LACERS real estate portfolio is separated between core, core plus, and non-core funds. The core plus funds are usually open-ended with the historical net return between 6 to 9%, with the majority of the returns coming from the current income. The benchmark for core funds is the NFI Odyssey Index. The non-core funds is broken down between value-add funds and opportunistic funds. The benchmark for the non-core funds is the NFI Odyssey Index plus 200 basis points. So the value-add and the opportunistic funds are distinguished by their return risk profile, with the value-add historically providing leverage returns between 10 to 14 net of fees, and opportunistic returning 50% or greater. LACERS mainly deals with commingled funds, but we do have the ability to invest in separate account vehicles. LACERS target allocation to private real estate is now at 7%, and we're currently hovering around 5% or so. Some of the investment concentration guidelines for LACERS are we can't allocate more than 30% to a single manager. For non-core funds, the maximum investment commitment is 15% of the real estate portfolio allocation. For core funds, the maximum is 20%, and LACERS will now consider investing in a fund that's less than $150 million of committed capital. So how do we even get to this point? Well, the real estate selection process, it starts with our annual real estate strategic plan. Once that's in place, staff works closely with the consultant and selecting managers based on their set plan. The selection process in real estate mirrors that of what Robert mentioned in the private equity space. Townsend, who is our real estate consultant, also does most of the heavy lifting for due diligence. And staff will work on the back end as performing reference calls, additional meetings, review information in the data room, and et cetera, until we feel comfortable enough with the potential investment. Just like private equity, we also hold regular meetings with our consultants and discuss managers in the investment pipelines. We'll also have internal meetings that include the CIO and CEO before making any decisions to invest. To add to the minimum manager qualifications for managers, we have a minimum of $200 million under management, have no less than 3 years of real estate investment experience, or be able to demonstrate a track record of 3 years. One of the few differences in real estate to private equity, however, is that the policy currently doesn't have a discretion in the box. So any investment decision needs to be approved by both the investment committee and the full board of administration. That's my portion. And with that, I'll turn it back to Barbara Sandoval.
Thank you, Eduardo. At this time, we'll turn it over to Felix Feltz from Townsend, and he'll be discussing the real estate process for working with our consultants.
Great. Thank you, Barbara, and good morning, everyone. I'm Felix Feltz, one of 3 individuals at Townsend responsible for consulting LACERS on a private real estate portfolio. And I just have a few slides to walk through discussing more the process of how we work with LACERS and how we do our due diligence on managers. So I'll start on the next slide. And as the real estate consultant, we have responsibilities including investment and strategic planning, investment underwriting, portfolio monitoring, reporting, and a few others. But the most relevant for today's discussion is really the investment underwriting or fund due diligence process. And that process is really led by a dedicated and independent team within Townsend. And our colleagues on this team lead all of the firm's manager research efforts, regardless of client relationship. But myself and the rest of the LACERS consulting team work closely with our due diligence team to find those groups that are the best fit for LACERS portfolio. And that's based on the annually approved investment and strategic plan that Eduardo mentioned. Out of the list of top fund picks from our fund due diligence group, we will choose the most appropriate ones for LACERS, recommend them to our internal investment committee, then to LACERS staff. LACERS will then do their own due diligence, set up meetings with the GP, and if LACERS agrees with our recommendation, we'll bring those forward for formal recommendation to the investment committee at LACERS and to the LACERS board. On the next slide, I will talk a little more about what our due diligence process looks like, as I know this can often be confusing from an outside perspective. But at a high level, there are really 3 stages. So first is the screening stage. For this stage, we ask managers to send us their offering materials. We have a centralized email address, which I will share at the end of this presentation. And we ask all managers to send their pitch books, or PPNs, or other materials to that email address. Sometimes LACERS or other clients receive those offering materials and forward them on to us as well. And we will register manager and fund in our database. And there's an initial due diligence questionnaire sent out to GPs to compile some high-level data. This is an online questionnaire that just helps us categorize the fund offering and find the appropriate peer set. And in this screening stage, individuals on our due diligence team will then look at that information, just evaluate the higher level fit with our house views, and also with client interest for the particular strategy. In some cases, meetings will be set up to talk to the GP and learn more about firm strategy. If after this initial screening stage and a potential meeting, there is interest from our team to dive into deeper due diligence, the fund moves to the second stage, the underwriting stage. In this stage, we request a comprehensive due diligence questionnaire and we assign an underwriter. This stage can often take several weeks to several months to complete. And throughout that process, we also determine if an opportunity may be more suitable for some clients than others, or whether it is a broadly recommended opportunity. If the final verdict is that the fund is not compelling enough, we will still continue to track the group and continue conversations. And this is really key for all newer groups listening. We want to keep an active dialogue and monitor any progress, even if LACERS or other clients don't end up partnering with you on this current fund offering. If a fund is approved by our IC, we will share it with LACERS if we think it's a fit for their portfolio. LACERS also regularly receives a list of all actively underwritten funds and all approved funds, so we will talk through those names and potential fit, even if there's not an official recommendation made to LACERS. On the next page, we'll talk a little bit more about the emerging manager sourcing process and LACERS efforts specifically. But at a high level, emerging managers really go through the same due diligence process as all other managers. But we just at a higher level look for groups to invest in themes we like from a macro standpoint. And we do like identifying specialist operators. So a lot of times these can be smaller groups that have specialist expertise in a specific sector and a specific geographic market. And they may be less experienced in raising third-party capital, but we really work on establishing new relationships wherever possible, whether that's through conference attendance, events like these, outreach and regular sourcing channels, and our client relationships. For LACERS specifically, just under 30% of non-core real estate funds we recommended over the last 6 years were funds sponsored by emerging managers. So our process opens the door for emerging managers with a unique value proposition. And we'll continue to try to find new emerging manager relationships for LACERS based on the policy criteria you see at the bottom of this slide. I hope this overview was helpful for you. On the next slide at the bottom, you see the email address we ask all managers to send their offering materials to. It might be a little cut off right now, at least on my screen, but it's townsendduediligence@aon.com. And I believe these slides will be available on the website as well. So thank you for your time. And with that, I'll turn it back to Barbara to introduce the next speaker.
Thank you, Felix. And yes, we will be posting the slides on the LACERS website. So they will be available for view after the symposium. At this time, I'd like to turn it over to David Fan with Axia, and he'll be discussing private equity and how the consultants work with LACERS portfolio. David?
Good afternoon, everybody. David Fan or actually good morning. David Fan from Axia. I wanted to reemphasize how emerging managers is something very important to the board, the executive director of LACERS, the chief investment officer, the staff, and they continually remind us, all of us consultants, of the strategic importance they see in having a successful emerging manager program. So kudos for the holistic commitment that LACERS has to emerging managers. Now, if we could turn to the Axia slides, that would be terrific. Just a few words about Axia, since some of you don't know us. We're LACERS is private equity consultant, but our platform also covers hedge funds, private credit, real assets, and real estate. And across each of those business lines, we are interested in emerging managers and supportive of emerging managers, and we have an open door policy. So anybody with a strategy that I think covers the private markets in those areas should contact us. Feel free to email me directly or my colleague Jeff Goldberger. Our email addresses will be at the end of the slide deck. And rather than going through our process, because our process is similar to Townsend and NEPC's, I wanted to maybe spend 2 or 3 minutes really giving emerging managers a perspective of what we've seen covering emerging manager fundraisers for the last 15 years. Point number 1 would be expect a 2-year process for fundraising. We wish it was shorter, but oftentimes we find that the emerging manager fundraising process from start to finish will take at least 2 years on average. Expect to have a lot of meetings with the same prospect, really because they want to get to know you, but they want to test the consistency of the points you're making as you tell your story. Have a verifiable track record. I know several people mentioned the track record piece. We find that firms spinning out of private equity firms or venture capital firms often can't extract a verifiable track record. If you haven't left your firm yet and you want to become a independent firm, make sure you negotiate with your employer to get your track record. And not just the high level numbers, but every cash flow. Consultants like us tend to fixate on very detailed cash flows related to the investments you've made in the past. The next point I would make is make sure the story you're telling has proof points. And what I mean by that is the strategy that your new fund is going to be raising and investing should have items that you've done in the past, where if you're going to raise a venture capital fund, make sure you've made venture capital investments using the similar thematic or the same thematics that you expect to execute on going forward. Oftentimes we find firms drifting into new strategies, but they can't really prove that they've been successful executing on that. So the proof point piece is critical for firms like ourselves to make to really verify that you're able to do what you say you're going to do. On the references piece, make sure that you have legitimate references and expect consultants like ourselves to call people not on your reference list. In the age of social media, LinkedIn and other venues, we're going to be able to find other people that worked at the same firm or might know you through various business relationships. And a lot of what you tell us is going to be verified by not only your references, but off your reference, but people we're going to be calling that might have known you in other contexts. We find people often embellish about their experience. Don't do much embellishment because our jobs as consultants is to verify everything. Make sure you spend time developing a back office, a compliance function, establishing relationships with fund administrators, banks if you're going to use a subscription line of credit. A lot of what we're doing today, because of fraud that has occurred within the private market industry, is operational due diligence and the verification of every operating facet of the fund that you intend to establish. So all of those elements need to be in place, or at least a plan in place. And we're going to expect you to be a registered investment advisor as stated by the Securities Exchange Commission. And so make sure those elements are in place. And the first thing we would tell most folks that are interested in setting up a fund is to look at the Institutional Limited Partners Association questionnaire and start thinking about how you would respond. And in fact, if you have a chance to fill that out. Consultants like ourselves are highly reliant on questionnaires, and we have our own version, but I would say the ILPA questionnaire probably covers about 80% of what the Axia Torrey Cove questionnaire is going to cover. So we want you to be ready for a fairly data-intensive response to our questionnaire. When you meet with limited partners and prospective and other prospective investors, oftentimes there's a tendency to want to be all things to all people. So if you have a conversation with one prospective limited partner and they're interested in a growth equity style management, and another wants a value buyout manager, make sure your story doesn't drift. I think it's easy to want to satisfy what the prospective limited partner might be looking for. Don't engage in style drift or thinking that by changing your approach that you're going to get a commitment, because I think what we're looking for is consistency in the story. Think about firms that are seeding emerging managers as potential one venue. Also talk to a lot of endowments, family offices, and individuals, as they might be easier capital to raise from. I think also invest in a data room. We often find managers that haven't made that investment and really tend not to have the fulsome set of information we're looking for. And the last thing I think you should be considering is perhaps using a placement agent. While a lot of the state and municipal plans discourage the payment of placement agents, we find that placement agents often could help establish the information foundation necessary for a successful fundraise, especially if you haven't gone through a fundraising process before. I think there's a discipline to the fundraising process, and those that do it professionally to assist could really provide a benefit to your efforts. So let me pause there, and I know maybe we could turn to the last slide so they could see Jeff and my email address to the extent you want to reach out to us. We also have Trevor Jackson on our team as well. The three of us help cover LACERS. All of us are available to have a discussion with you all, and we'd love to try to meet with you all as you embark on this effort.
Great. Thanks very much, David. That was very insightful about some of the hints that you provided just for our merger management community. So the next section is the Q&A. So as a reminder, if you are interested in submitting a question, please use the Q&A function below and we will address all the questions in due time. So the first question I received was asking about providing some insight into our private credit portfolio and where that fits into our overall program. So private credit is still relatively new to LACERS. As I mentioned earlier, we have 3 funded ones that we currently have. And in terms of funding, it's still pretty early on. We really haven't really ramped up in terms of commitments, but it is going to be a significant part of our allocation on a go-forward basis as we have a 5.75% target to this asset class. After the global financial crisis, obviously we recognize that bank lending has pulled back, and we realize in a search for income, private credit has become a very important asset class. So for that, we have it currently under our credit opportunities asset class right now, and we have presented to our investment committee a formal implementation plan, and that's going to the board for formal approval this Tuesday. So I think again, it's an asset class that we are looking at right now very actively, and we may augment it in the future depending on market conditions. I received a question. This is about general allocation to the venture capital asset class. Do we have a specific number that we commit to emerging managers in terms of funds per year? And how do we see the venture capital class evolving in the next 2 years? Maybe I'll leave the last question for David. But in terms of our venture capital portfolio, our allocation as it stands right now is 13% of our overall portfolio. We do not have a specific number that's dedicated to emerging managers within that allocation. We visit this on an annual basis within our strategic plan based on market conditions. We may increase our venture capital exposure to emerging managers or decrease it, but again, there's no specific number. In terms of the funds, in our emerging manager policy, we commit to funds 1 through 3, and Clark Hoover explained that earlier in terms of the criteria. And in terms of the outlook, maybe I'll leave that to David. Maybe if you talk about how you envision how venture capital will look the next 2 years or so.
Sure, Wilkin. We've made a sizable investment in several venture capital funds of late. It clearly is a hot area. Everything from early stage to late stage and growth equity as well. The biggest challenge we have within the venture capital asset class is the funds tend to be a little bit smaller. And as we try to put it into the program, sub $100 million funds tend to be challenging and complicated for institutional investors, including LACERS. We believe there is a differentiated skill set for VC firms that they need to articulate, proprietary sourcing, where some operating experience, where some knowledge base that allows them to be more successful. But it's something that we've invested in out of the EM program, but also out of the core program as well. So we expect that next year we'll be making maybe a 10 to 20% investment into venture capital funds out of the private equity budget.
And one thing I'd like to add on top of that, AXA has been great in terms of providing us good, very qualified emerging managers in the venture capital space. I would just kind of mention one of the recent commitments we did to a venture capital strategy in the EM space was a seed strategy, Series A. AXA was able to source for us two prominent general partners who have ties into the Silicon Valley, Stanford network. And I think that one for us had a very compelling story. Were able to source very specific deals from the Stanford network. And I think that was kind of the value add for us and how this GP was able to stand out and what the value add was for us to commit to this fund. And another question about what is the minimum amount that LACERS will invest in for emerging manager. Our typical minimum bite size for emerging managers is around $10 million. Typically, obviously, there's a lot of work involved in terms of the due diligence, the legal work, the operational aspects. So for us, in order for us to commit to a fund, I think for us, we prefer at least $10 million to commit to a fund. But, obviously, depending on the size of our program and our target asset class and our overall portfolio, that may change in the future. A question came in about, will LACERS act as a lead investor in a new emerging manager fund? So if that question is, will we invest in fund ones? The answer is yes, we would do that. We have done that in the past. So we do not have a policy that precludes us or excludes us from investing in fund ones. Typically, we do have to do a lot of due diligence on fund ones and the prior track records, their prior firms, how their infrastructure is, how the general partners know each other, but we have not shied away from investing in fund ones as we realize there is a potential for outperformance there. There's a question about policy for co-investments, criteria and processes. Do you co-invest with existing managers? So for that question, I'd like to hand that over to Clark Hoover since he handles the policy aspect.
Yeah, thanks, Wilkin. So we actually have a separate co-investment policy, which you can find in our investment policy. We do not have a limitation on whether we do co-investments with existing GPs with whom we already have a relationship or new GPs. But with that said, our co-investment program is very new. So we have not done a direct co-investment to date. So we're still building that internally. But with that said, we're certainly open to having conversations with you about potential co-investments.
Yeah, just to add on top of that, we do have a co-investment commingled fund, but not direct co-investments. We are trying to obviously make this as inclusive as possible. Commissioner Serrano has been a huge champion of that, where initially, we're thinking how we structure the co-investments, and she recommended that we canvas the whole entire universe of managers to be considered. So there's a question about succession events and whether or not how that is considered an emerging manager fund number. So, for example, if a firm may be raising fund 7, but it may not be the first, second, or third time the current managers are managing the strategy. Would this situation fall within the EM bucket? So for us, I would say that probably does not fall within the emerging manager criteria. We have seen events where there is succession events with senior partners who are retiring. For us, we want to make it a level playing field where if a new firm that's a spin out or they start their own firm, we want to consider those truly as emerging managers, not folks who have been managing a fund for 10 years and then passing it over to the next senior partners for another 10 years. So for us, again, we want to kind of make an even opportunity for you all to get capital from LACERS. So the answer for that would be a no. There's a question about infrastructure and who would handle that. So right now, we actually do not have a dedicated infrastructure allocation at LACERS. That is something that we may look at in the future, but as it stands right now, when we did our asset liability study, infrastructure was not one of the items that was on the list to be pursued. But obviously, the current administration, even the past administration, has mentioned the infrastructure spending. But again, that's something that may be entertained in the future, but not currently. Maybe I can pass this question on to David. What type of private equity strategies are you all looking at right now? And how does emerging managers fit into this? Is there anything that's particularly more advantageous for emerging managers to pursue that would make it an easier allocation for LPs like LACERS?
Interesting question. We don't really have a particular emphasis on any strategy within the emerging manager opportunity set. I think we're looking for talented individuals that have demonstrated past successes that are starting their own firms I think Commissioner both Son and Serrano both spoke to, which is adding incremental alpha to the portfolio. And that could be within venture capital, private equity, distressed debt, any segment of the marketplace where a group of individuals could demonstrate a differentiated approach that could outperform. And so we're open-minded and willing to listen to anybody that has a good idea.
Thank you, David. There's a question that talks about a situation where an emerging manager only has $25 million of capital as it stands right now. And our threshold is $100 million inclusive of LACERS commitment. So the question is, when is a good time to develop a relationship with LACERS, knowing the fact that right now the threshold is below our minimum threshold? I would say that once you have kind of line of sight to where you can get to almost 100 million or even, somewhat close by, definitely feel free to reach out to us, our consultants, and let's start the conversation, because we know that things work very quickly, that you may have other consultants helping you on your behalf, and things move very quickly. And we've seen situations where all of a sudden they go past 100 million and go to 125, 150 million dollars. So we definitely want to be aware of your strategy and keep us up to date on your fundraising process. So I would say if you have a lot of traction or a lot of visibility into your future commitments with other allocators, definitely open up the dialogue, and we'll be more than willing to entertain a conversation there. Maybe I could pass it on the next question on to Felix Fells from Townsend. Maybe can you talk about ESG and how you integrate that into your due diligence process? Maybe some red flags you're seeing there, and just basically some hints that you would give to other real estate emerging managers on the line today.
Yes, happy to. It's definitely been a very important topic. When we underwrite a fund, we have a separate portion of our due diligence questionnaire that's targeted at ESG. So we have an ESG team, we have an ESG due diligence questionnaire, and based on that, we do assign a rating to each fund that comes through our underwriting pipeline. But there's no one thing or red flag that stands out. I mean, we're I think in summary, we're looking at, first of all, UNPRI signatories and GRESB reporting firms. So, GRESB, the global real estate sustainability benchmark. Now, that's obviously a good starting point for any data collection, really for the environmental aspects, but also the social and governance. But we look at additional things like, do they have, responsible contractor policies? Is there a DEI policy, sexual harassment policies? So there's a lot of different things we look at. It is a very important part in the evaluation process, but that's not one thing, that stands out. It's really, I think, more than 20 different questions specifically focused at ESG that we ask, and based on that, we evaluate how a firm fits in with our views and our clients' preferences.
And if you don't mind, maybe David, I could pass that on to you as well, considering ESG considerations are at the forefront of most investors in private equity.
Yeah. Just to build on what Felix said, firstly, LACERS is a signatory to the UNPRI. It's something I think the board felt was very important to them, and they've been signatories for about, I guess, over a year now. We at Axia also subscribe to the UNPRI principles, and we are signatories as well. ESG integration is something very important to, I think, LACERS and a lot of our other clients. And a lot of our ESG work is really identifying risk factors that a manager might have that could cause reputational challenges. So everything from their workforce policies and philosophy on minimum wage, which I think surfaced recently amongst a manager, to their approach to climate change. And so I think the concept of ESG integration and diversity, equity, inclusion are things we take in consideration, especially for clients like LACERS, where those concepts are extremely important. And so we, like many others, use an ESG scorecard in evaluating managers to identify potentially problematic areas and as well as reinforcing the positive attributes that a manager might have adopted to their investment program.
Thank you, David and Felix. There's a question about, can you please shed light on your funds allocation to Chinese market and relevant plans? So for us, we do invest in Asia. I would say we are not country-specific investors. So we don't have a China-dedicated private equity fund, for example. But for us, we've typically committed in Pan-Asia funds. Our exposure is around 3% at the moment. Obviously, as China is large as the economy they are, that is a very important market in terms of growth. And there have been obviously political, geopolitical issues recently from the tech crackdown. So I think for us, it is an area that we will look at. I think we do not have anything specifically that prohibits investments in the Chinese market. So, again, that's something that we're probably looking at more kind of on a Pan-Asia basis. But I don't know if David or Jeff, if you want to add some color there on kind of what you all think about in terms of the Chinese market. And then later on, if you want, Felix, if you don't mind adding on top of that.
China is an interesting place. We've looked at it for a long time now. We've invested in Chinese private equity firms as well as Chinese venture capital firms. We're very sensitive to the U.S.-Sino relationship now. There is clearly a lot of political attributes associated to that dialogue. We are long-term investors. We do like some firms that are able to bridge investment opportunities in the United States and China. And there are some secular themes that we think a long-term investor could benefit from vis-a-vis Chinese exposure. But right now, I think we're still very much focused on best managers in all regions, including China. And a lot of our mandates are customized to a specific client. So, not putting words in LACERS policy, but we're going to look at best opportunities, and if one of them happens to be a Chinese manager that we think could add incremental value to the LACERS portfolio, we'll certainly consider it.
I don't know, Felix, if you have any commentary on the Chinese real estate markets.
Yes, happy to make a few comments there. So we do cover the Chinese real estate markets. We have a dedicated team in Hong Kong that covers all of Asia real estate for us. We've had investments and clients invest in China over the years, most recently focused on the logistics sector. But for LACERS specifically, we don't have a dedicated target for international investments. We really do it on a tactical basis. So we do look at all opportunities out there, want to make sure we find the best tactical opportunities. And if one of those funds happens to focus on Chinese real estate markets, if there's a case to be made that we can achieve higher risk-adjusted returns than in a domestic strategy, then we'll certainly look into that. But of course, you have to, for a US public pension fund, you have to look at all the additional risks that come with international investments in general. So it introduces tracking error to the benchmark. LACERS has a US-based real estate benchmark. So anything abroad introduces that additional tracking error. Obviously, the currency risk, there's tax risk associated with it, political risk. So you really have to be paid for it. There has to be sufficient alpha to be generated compared to domestic strategies or strategies in other countries.
Great, thank you for that. There's a question about, do LACERS have a target breakdown between the sub-asset classes such as venture capital, growth, buyout for the private equity portfolio? So looking at our current portfolio as it stands right now, we have a 60% exposure to buyouts, which is broken down by 30% to large buyouts, 25% to medium buyouts, and 4% to small buyouts. The long-term suggested kind of target range that we have is 50 to 65%. For venture capital, we currently have a 26% exposure, 13% to VC, 12% to growth equity, which the long-term target is 10 to 35%. Credit is at 8.4%, and our long-term target is 10 to 25%. And then we also have a natural resources component that's around 6%, and the long-term range is 0 to 5. One thing I'd like to highlight is that we do adjust these on an annual basis in our private equity and real estate strategic plan, depending on the market that we currently see. So if certain strategies are more in favor, we will tweak that up. So that is something that we constantly visit, and that gets approved at the board level. So depending on the market environment and what opportunities we see in the market, that will be flexible depending on what we see out there. There was a question, I'll address this to David. Somebody wanted to hear more about your ESG scorecard, and perhaps that might be a good question for Carole, or I'm sorry, for Felix as well. So David, if you don't mind addressing that one.
So I think our approach is to, so I sit on our firm's ESG committee, as well as Heidi Poon, who covers venture capital for us and is involved in the LACERS relationship as well. A lot of the ESG related questions come out of our operational due diligence questionnaire that we expect all managers to fill out. It's more of a red light, yellow light, green light type of approach to ESG, where certain issues that are bothersome and get flagged. For instance, child labor, or maybe exposure to liquor and gambling, where things, the obvious attributes get flagged, but even businesses that might have some complexity to it, like for instance, mixed martial arts and the the ultimate fighter type of concept, where we've seen some managers participate, and just really flagging it so that investors like LACERS understands the potential headline risk associated with either a manager or a specific investment. We want people to go into investment ideas eyes wide open and understanding all of the factors that could create either a headline risk or create a bad investment outcome. And so, I think the ESG framework allows us to be able to communicate those attributes effectively to our clients.
Then maybe Felix, do you want to talk about your?
Yes, I'll just add a few things there, but it's a similar process as Axia's process, just outlined by David. So it is also, red light, yellow light, green light. We really have 3 stages, 3 different ratings that are incorporated into our fund due diligence when it comes to ESG. I mentioned earlier that we have a separate ESG questionnaire and an ESG team that evaluates these. Historically, the real estate asset class has been very focused on the E, because there's a lot more data that has already been collected on utility usage and the overall environmental impact of your buildings. But more recently, the S and the G portion has been more and more important as well. And really, it's making sure that groups have the right policies, procedures, and priorities. So we try to engage with groups. We understand for emerging managers with smaller teams, fewer resources, you may not have all of these defined upfront, but we really want to open that dialogue and let people know if something is not best practice, what can they work on, what can they improve to really score higher on that ESG component. Makes sense.
Thank you very much. So there's a question about how does staff from LACERS coordinate coverage and reporting of emerging managers within the investment team and to the board? So for us, we communicate to our board on usually a quarterly basis after we have committed to funds. This is for the private equity space. And at that point, we provide a memo that staff writes and also a memo that our consultant writes. And at that point, we notify, whether if it is an emerging manager, and that way the board is notified when we do commitments. And also on an annual basis, we present a emerging manager report. And this report is pretty detailed. It shows the dollar amounts awarded by asset class to each emerging manager, our emerging manager exposure, searches that we conducted, EM conferences that we've been to, how many meetings our consultants have taken, and performance data. So that way it's pretty comprehensive. And again, we have to present this on an annual basis. So this kind of just shows us our progress in getting to our no less than 10% goal. One question that we had was just about how things are progressing along in terms of operational due diligence and I assume investment due diligence with COVID slowing down. So, I'll address this question first and then I'll pass it off to Axia and Townsend. But I would say for us, given that, there's still the COVID, out there and also the various variants, we're still very cautious. We're taking a very cautious approach to going on site, visiting managers. As of right now, actually, we're not taking in face-to-face manager meetings just yet. But we are doing, very slowly annual general meetings that we're very cautious about. And I think for us, we've been doing a great job of taking meetings on Zoom. I think we're able to get the information that we need from their prospective GPs. We're still able to ask the hard questions. So I think it's worked out so well so far. And I think when 2022 comes around, we'll definitely reassess that. But as it stands right now, we're still doing everything virtual. For example, our board meetings are still done virtually for the remainder of this year. So maybe I'll pass it to David first. Maybe if you could talk about what Axe is doing in terms of operational due diligence, investment due diligence, and how you all are integrating that on-site versus virtual.
Right. So I'm actually in Axia's offices today, and actually Jeff Goldberger, one of my colleagues working on this, the LACERS relationship, is here with me in the conference room. We are beginning to be back in office, both I think globally in all of our offices. London opened up a couple of weeks ago. San Diego is opened up. New York has opened up. I think people are back in office in Tokyo and Hong Kong as well, and in Athens, Greece. We are taking in-person manager meetings, but managers have to be vaccinated. So we are returning to in-person meetings. COVID was interesting because we all thought that there would be a slowdown in fundraising for private equity and actually hedge funds, private credit, real estate as well. That hasn't happened. We're facing a tsunami of investment research activity. In fact, we almost believe we're nearly out of research capacity in this fourth quarter as the number of managers fundraising have increased dramatically. What has helped ourselves and our clients through this COVID process is the use of operational due diligence. I think that component of our investment research process has allowed a lot of clients to bridge the need to have in-person meetings with managers. And I think looking at the operational facets of the fund and getting comfortable with the elements we talked about is just something that will stick with our investment process. But I think more and more clients are comforted with that. It doesn't obviate the need for an in-person meeting, and I expect that by 2022, I think all of our clients are going to want to be able to meet the investment managers in person. So I expect back to normalcy next year, hopefully with no consequences related to COVID mutations. And I expect that international travel will probably return. Having a global footprint has allowed us to make investments globally as well. Our Asia offices have been very active investing in Asian managers as well as our European offices. So, but what has surprised us is just the sheer amount of activity that has occurred in the private markets.
And for us at Townsend, it's a similar situation. We are reopening offices slowly. So we're starting to take some in-person meetings again, but we're still doing a lot of things virtually. Think for due diligence. There's certain aspects that have to be done in person. You know, if you're underwriting a fund that already has a few properties acquired, we definitely make sure someone goes and visits these properties and tours these markets. But for just overall manager discussions, we are having a lot of them virtually. And similar to private equity, you know, we've had a very active fundraising year in real estate, or 2 years at this point, really, and you know, probably taking more manager meetings than ever. So that's one of the things that Zoom has made easier. But overall, you know, we are also expecting a little more normalcy. I mean, next year, probably more people in office, probably in-person meetings again. I know some people are attending conferences this week, even, or next week. So it's opening back up.
Yeah, no, definitely same on our side as well. I think our staff are kind of taking more meetings than we've ever done before. Obviously, the convenience of Zoom has helped out in terms of meeting prospective managers. So we definitely think that's been great so far. Okay, I think we'll probably have time for just one final question. I've received a few questions just about, about venture fund-to-fund investments, our ideal allocation for venture capital, if there's any specific targets. So I would say we're willing to consider all of those respective strategies. We don't have any specific targets for sub-strategies within VC as it stands right now. We obviously invest in early, mid-stage, all multi-stage. So I think it really just depends on the opportunity that we see from the emerging managers. We definitely have an open door policy. So I think definitely if you think that something might be a potential fit for us, definitely feel free to reach out to us and our various consultants, and we'd be willing to entertain them.
Thank you very much, Wilkin, David Fan, Felix Feld, and our private equity team. At this time, I'd like to turn it over to our LACERS General Manager, Neil Guglielmo.
Thanks, Barbara. Good morning, everyone. Thank you so much for joining us this morning for this inaugural LACERS Emerging Managers Symposium. So I'd just like to start off, we've done a lot of thinking thus far, but I'd like to thank our board president and Commissioner Serrano for their leadership, and really the entire board of trustees at LACERS. They've been extremely supportive of staff in helping us, our consultants, move further in this direction of being a good partner with so many of you emerging managers out there, really to your benefit and to the benefit of the plan and all the members that we serve. So looking forward to more of those partnership opportunities going forward. I also want to express my appreciation for our Chief Investment Officer, Rod June, and the entire investments team. I mean, it's a very small but nimble group. They do terrific work. I know they're happy to answer your questions and to connect with you. So please reach out. They can help answer questions, like I said, help you navigate what our process is, and just what it is to work with a government institution. I know it's probably a bit different from what other types of contractual relationships that are out there. I'd also like to thank all of our consultant partners, David Fan with Axia, Carolyn with NEPC, always there at our board meetings to answer questions for our team and for our commissioners, and Felix Fels with Townsend, and all of your respective colleagues as well. Thrilled to have you all here this morning to join us for this symposium, so thank you. I just want to, reemphasize some of the points made by staff earlier. On the website, there's just a wealth of information about LACERS, and also specifically, there's a tab dedicated to investments where you can learn about our investment policies and strategies. You can look at our investments performance reports. Those things are changing, evolving over time as well. We have a responsible investment policy that'll be moving its way forward. We have a ESG risk framework that was approved by our board earlier this year that went into effect. So lots of exciting things that are changing, and keep up to date on what we're doing at LACERS. Again, the website's a great resource. You can sign in and actually register to be notified for upcoming RFP and other opportunities. You can get contact information for my team. And we're going to post the entire video from this morning's symposium, as well as all the Q&A, including those questions that we were unable to answer directly right now. We will respond to all those questions, and they'll be posted on the website. And all the presentation slides will also be there. I'd like to encourage you further. We want to hear from you so that we can make this symposium even better as we go forward. This is just the first of many, many symposiums we're going to hold semi-annually. So we want to make sure this symposium is useful and helpful for you. So ask us those questions, or tell us what challenges or issues you have, things that you'd like us to see covered in our next symposium, and we'll be happy to take that under consideration. So I think that really wraps it up for me this morning. But I do want to thank all of you who have made the time to join us for the symposium this morning to ask those questions. And again, we really look forward to engaging with you and partnering with you and moving our plan forward, hopefully with your assistance as we go into the future. So thanks so much for joining us.
Okay, what amazing morning. We had almost 200 people participating in this symposium. So let's give everybody a round of applause. I also want to give a special shout out to Barbara Sandoval, who was the lead on this, putting this fantastic event together. But this is an official meeting, so I have to finish off with some official business. So at this point, in all our meetings, we take public comment in our efforts to be open and transparent. So with that, I am going to open it up for public comment, and I am going to ask Ani to read the instructions if in case you want to give public comment.
Great, thank you, President Ruiz. If anyone wants to make a public comment that has called in, please press *9 and I'll see that your hand is raised. If you joined via the webinar, you can use the raise hand function on the bottom of the screen. It shows a little hand and it says raise hand. So either you can press *9 or you can use the raise hand function for the webinar. So please go ahead and do that, and we'll check and see if you want to make a public comment.
Public comment is now open. Okay, do we have any takers? I actually see a taker.
Let's see. I don't know if they lowered their hand, or let's see. Maybe they lowered their hand. Oh, no, they did lower their hand, so I don't know who that was. So there are no hands raised.
Okay, so public comment is now closed, and our next meeting will be held next Tuesday, October 26th. And with that, this meeting is adjourned, and thank you everyone for participating. Have a great day. Bye.
Thank you, everyone.